Good afternoon, everyone. Good morning. I hope you can all hear me well. My name is Chris Arnold. I'm a partner in the finance practice in London. Very happy to be joined by Marla Matusik, who's an associate in our New York office, on this reverse inquiries workshop series about issuing credit-linked notes. We plan to talk for around 45-50 minutes. And there's an opportunity to ask questions. If you would like to ask questions, let me encourage you please to use the chat function on WebEx if you're able to find that. Otherwise, please feel free to take yourself off mute and ask us questions as we go through. You all started on mute when you joined the call. Please, if you're not asking a question, we ask that you stay on mute. We're going to have CLE credit available for the session today. Hopefully, if you're looking for CLE credits, you should have received an affirmation form and an evaluation form together with the connection details. And we will announce the CLE code once during the middle of the presentation and once at the end. So please do make a note of the code if you are seeking CLE credits. CLE forms can be returned to the Mayor Brown address that was provided for on those forms. That's the housekeeping out of the way. We're going to get started with the presentation now. Just by way of background, I've been working with credit-linked notes and credit derivatives really my entire career. And we saw very significant issuances of credit-linked notes before the financial crisis, and then there was obviously something of a dip after that, but there will continue to be credit-linked notes issued into the market. And just recently, in the last year or so, we've seen a bit of an uptick here at Mayor Brown with issuances and programs incorporating credit-linked note mechanics. And I've worked with Mar on a few issuances. And so we thought it would be a good opportunity to run a workshop series for clients and interested parties. For many of you, I'm sure this will be something of a refresher course on your existing knowledge of CLNs. But for maybe some of you who are newer to the subject, hopefully this will help to demystify it for you. We could just start with the first slide. So I just put this up because as we were preparing for this presentation, I noticed last week an interesting story in the Financial Times relating to credit-linked notes, and that was the story of the Cardinal Becciu who'd been discovered investing Vatican funds in all sorts of different investments, including high-end London property, and the FT had also discovered that one of the investments had been into a credit-linked note linked to the car rental company Hertz, which we'll all be aware filed for bankruptcy recently. And obviously the FT picked up on this story because they'd been a previous quote from the Pope saying that credit derivatives encourage the growth of finance of chance and gambling on the failure of others, which is unacceptable from an ethical point of view. And hopefully, during the course of this presentation, we sort of dispel a few myths relating to credit-linked notes. And the sort of first of those is that by investing in credit-linked notes, as the Vatican was, maybe unbeknownst to the Pope, they were obviously, in fact, betting on the success of the underlying corporation rather than the failure of that corporation. And in that respect, they seem to have got remarkably lucky because their particular credit-linked note matured just a month prior to the insolvency filing of Hertz, which would have triggered a credit event and obviously led to a loss of principal for the Vatican. So, so they're obviously investors from all sides in credit-linked notes, and not all quite so many as high profile as the Vatican, but I think this sort of shows that they are quite a common product in the market, and you know, serve a useful function in terms of providing investors with access to credits of corporate sovereigns, others, and we'll talk a bit more about that in this presentation. So just moving on to the agenda, what we're looking to talk about on the next slide. We're going to do just a quick introduction. What is a credit-linked note? The basic anatomy of a credit-linked note, and look at the various different types of credit-linked notes that are issued in the market and the reasons for that. And then just Marla's going to take us through some of the sort of key concepts that you see in credit-linked notes and the underlying credit derivatives, concepts like credit events and deliverable obligations, the terminology that's used commonly for credit-linked notes. And then we're going to look at some of the distinctions, the various different flavors of credit-linked notes that we see in the market, in particular looking at bank credit-linked notes issued off bank programs, and then credit-linked notes issued by SPVs, and the differences in those structures and the reasons why one might issue from a bank or from a particular special purpose vehicle. We're going to look briefly at the difference between single name, basket, and index CLNs, focusing in particular on CLNs linked to indices such as iTraxx and CDX. I'm going to explain tranched and untranched structures for index CLNs, and then look briefly at the different potential settlement methods that you have for credit-linked notes. Just going to spend a couple of minutes also looking at some of the basis risk that you might find between credit-linked notes and CDS. So one of the very important sort of questions that we ask first when working on credit-linked notes is, what is the hedge? What exposure are you trying to manage with this credit-linked note? And making sure that we understand that there are potential risks between the underlying product and the credit-linked note, and the ways in which we can minimize that. And we can look at some of those in the session. And then a quick look at the documentation and some of the US securities law, regulatory and tax issues just at the end. So I hope that is along the lines of what you were looking for when you signed up and dialed in. As I say, if there are questions as they go along, please do feel free to use the chat function. So with that, I'll just pass on to Marla, who's going to kick us off with the basic anatomy of a credit-linked note. I think you might be on mute, Marla. Just.
Thanks, Chris. I was indeed. So as Chris mentioned, I'm just going to go through some of the basics. So a credit-linked note is a debt instrument designed to transfer a credit risk. The credit risk of a reference entity or entities, and those entities can be a single entity, corporation, government, etc., or it could be baskets or indexes, just like you would see with any other type of structured note, with the quirk, which we'll discuss in more detail later, that in the case of a credit-linked note linked to an index, it's not as you would see in, say, the equity space, where it's truly linked to that index. It is instead linked to a basket based on the components of the index as of the trade date. And the payments on a credit-linked note will include coupons, a payment at maturity, and then a payment at redemption, provided a credit event occurs. On the next slide, we've laid out some of the basics. So as you can see from the first diagram, credit-linked notes are fully funded. So as of the issue date, the investor will pay the full purchase price, which is normally the par amount of the notes, and receive the CLN in return. And then their return on the note will depend upon whether or not a credit event occurs, with the caveat that for notes linked to a basket or index, it will almost take on a note of notes type feature, where the principal ends up being divided and coupon ends up being divided between each of those names. So provided a credit event does not occur, it will function just like a normal debt instrument. So you'll receive coupons over the term of the note, or paid in a lump sum at maturity. And at maturity, you'll receive the final interest payment plus a return of your principal. And credit-linked notes have all sorts of different interest provisions. So it could be a fixed rate, or it could be a floating rate plus a spread. The only real constant is that, of course, you get a premium in exchange for the additional risk that you're taking on. If a credit event were to occur on the reference obligations or with respect to the reference entity, both the coupons and the principal will freeze. So the note will freeze. All future coupon payments, if it's a periodic payment, will be forfeited, and the principal and final interest payment will both be held to be paid at the same time, even though the principal payment determination has not yet occurred. And then for baskets, this again happens in two steps. So the principal and coupon attributable to the particular reference entity will be frozen while the rest of the note continues on. So now that we've kind of covered the basic economics of the note, next I'll get into what that hedge looks like on the next slide. So for the hedge will largely be determined based on, the type of hedge will largely be determined based on the type of note, which really falls into two categories. What we would call a vanilla CLN is really based on a note where you're just replicating a standard CDS contract in fully funded form. And because it's just replicating that vanilla CDS contract, it's also just hedged with a similar vanilla CDS note. The one caveat here is we would normally look at both documents just to make sure that we're lining up the terms as closely as possible to minimize your basis risk. And then the second category is the more bespoke CLNs, which are a little bit more complicated. But in a lot of situations, these bespoke CLNs are themselves the hedge. So in that sense, there's not a new hedge. It's hedging exposure that's already on the issuer's balance sheet, or may be it soon if it's not yet. And in this situation, this is where the terms of the CLN become a little bit more complicated during the note development process, just to make sure that we're capturing all of the relevant events and the relevant instrument without being over-inclusive where we don't want to be. And that's where you'll see kind of more work being done. In both cases, for both of these, I would just note that the notes themselves will borrow heavily from the ISDA CDS definitions. So you'll see terms and concepts very much the same if you're already familiar in the CDS world into the CLNs. And I think with that, I will be handing it back over to you, Chris.
Thanks, Marla. Yeah, I think it's probably fair to say that we've seen interest in both types of CLN in recent months. We're seeing more issuers looking to build in CLN provisions into their structured note issuance programs, looking to set up new CLN programs. But we're also seeing a big growth across the piece with banks looking to do effectively originate to distribute trades. So looking with respect to new loans that they're extending, new credit that they're extending to borrowers, looking at ways in which they can offset that credit risk using different forms of instruments. And that may involve credit-linked notes. It may also involve lots of different other types of products, really depending on investor preference and depending on what the relevant bank is looking to achieve, what risks it's looking to pass along. So this slide here is really just looking at sort of several other products which are in many ways akin economically to credit-linked notes of one type or another, and so each of which can effectively mimic the sort of economics of what you might see in a credit-linked note, but have different advantages and disadvantages. And again, this is sort of one of the discussions that we may have at an early stage with clients who are looking to effectively syndicate the risk of a new loan or a new extension of credit as to what the best form of instrument that may be, or we may be talking to investor clients who are looking to take exposure to a particular credit that a bank has, and talking to them about what's the most effective way of them doing that. So, Mother mentioned already that often credit-linked notes are just a funded form of credit default swap. So, why would you enter into a credit-linked note rather than a credit default swap? I mean, in some ways, the credit default swap is maybe preferable for some parties because there's no need to sort of pre-fund your losses in full. So in most cases, in the credit default swap at CDS, you're not posting the entire potential loss at the outset. Of course, the unclear margin rules have meant that there is an ongoing margining requirement, but typically that's not involving the posting of all of the funding amount at day one. So you can use CDS as a more leveraged instrument. Obviously, you have to put up less money up front in order to take the full exposure to the full notional amount. But on the flip side, there are more limited investor pool who will invest in credit derivatives, either because they don't have instant master agreements and derivatives trading relationships in place with their bank counterparties, or that their various investment rules prohibit them from directly entering into credit default swaps as a counterparty. So, as an alternative, they can do this in funded form using CLNs. Another way in which parties may choose to pass on that risk is via a total return swap or total rate of return swap, and these come in all sorts of different guises as well. And similarly to a CDS, they may not be funded. They may also allow an ability to tailor the underlying TRS to the commercial agreement between the parties, and that may involve things like influence on voting rights, what happens with payments of coupon and distributions, what the ability to sort of net funding legs against receipt of coupon on the underlying. And so lots of different ways in which that can be tailored, but TRSs typically then require quite a lot of negotiation. They're not done typically in a highly standardized form like a CLN can be off a CLN program. Loan participation is another way in which an investor can get exposure to a loan. There may be an advantage there if you're able to achieve the true participation of removing the credit risk of the grantor. Obviously, that's something that is in some cases achievable, but certainly in the US, where I am in London, that's not something you typically get with a participation. And similarly, it's not necessarily as tradable a product in participations as there may be in a CLN. And then you've obviously got a whole range of different products, including CLOs, synthetic CDLOs, CDOs, and all the sort of wonderful acronyms that we saw real prevalence of before the financial crisis. And they obviously will have similar characteristics to credit-linked notes, but broadly speaking, in those kind of products, you're spreading the risk across a broader portfolio of exposures. You're not so much tailoring the risk to specific exposures, and they serve a different function really to certainly to the more vanilla CLNs that we see being issued off CLM programs. So just on the next slide, just a couple of observations really as to some of the advantages or purposes. Just one back if possible. Sorry, just one slide back. So from the issuer or arranger's perspective, from the bank's perspective, credit-linked notes can allow them to transform CDS contracts into funded forms, so that sort of creates a potentially greater pool of counterparties for CDS, so that may be a potential source of profit by being able to sell CDS in funded form and to take a spread from the hedged unfunded CDS. On the more bespoke CLN side, effectively they can allow the syndication of the credit risk of the underlying debt. If you couldn't otherwise sell that underlying loan, or because of transfer restrictions where you wanted to maintain that relationship with your underlying borrower, but you've exhausted the credit lines for that borrower and you want to offload some of that credit risk, either to free up credit or to manage your regulatory capital. Similarly, like other structured notes, CLNs can be used to help with treasury funding requirements. So the bank is issuing the CLN directly, then obviously it will receive the upfront principal in full, which you can use for its general business purposes. And in the CLM programs, if you establish an issuance program, you have a relatively streamlined documentation process, and you can issue certainly the vanilla CLNs relatively cost effectively without much negotiation of the terms, and do a relatively high volume of those. From the investor's perspective, sort of flip side is if you're not permitted or not able to enter into CDS transactions directly, this gives you a way of accessing those markets and getting the same economics as you would essentially with a CDS contract. You have ability in the more bespoke transactions to tailor the kind of terms that you want for your specific requirements. So you may say, I want a 5-year instrument with exposure to this reference entity. So you can specify the maturity. You can select which entity you're looking to take the risk on, as the Cardinal did with the Hertz Corporation. And then you can obviously then build up a portfolio of different CLNs based on what requirements you're looking for. And then on the bespoke CLN side, it's a way of getting access to the kinds of products that normally would be restricted to bank lenders or larger private credit lenders, like big corporate loans or sovereign loans, or potentially more esoteric assets like letters of credit or Visa Master agreements or receivables, or some of the other kinds of typically bank dominated asset classes. And then you've got, as an investor, you've got effectively a tradable product. You've got a note which is transferable, typically without the requirement to get the consent of the issuer. There's not normally a sort of highly liquid market in CLNs, but you do have the ability to try and get a price discovery, try and get value on that. You can do valuations by reference to where the CDS is trading for a vanilla CLN, and so you've got something that's slightly more liquid than just a bespoke bilateral contract with your counterparty. So that's essentially some of the purposes of credit-linked notes. I'm just going to pass back to Marla now. I think he's just going to take us through some of the basic terminology and the concepts that we typically see in CLNs.
So yeah, I'll just do a quick and dirty of the main considerations that we'd be thinking about with respect to CLNs. So the first is obviously the reference entity, the actual corporation or other entity that would be issuing the obligations. One important thing to note is there usually is some consideration around successor entities. So what happens if that entity splits, fully goes into another entity, etc. And then the applicable reference obligations. The reference obligations being what the note will actually be linked to, or what will determine the payments on the notes. And there are actually several layers to the reference obligations, depending on what determination is being made, or if we're talking about what you may actually receive with respect to final payment on the notes. The next item is the principal amount. Normally, the principal amount will be in very high denominations, given the suitability concerns and the want to ensure sophisticated investors are the only ones purchasing the products, at least in the the US side. I know that can be slightly different in the European markets, but here we're pretty quib only. And this will also be the notional amount for all of the calculations with respect to the notes. Moving on to the interest or coupons period. As I mentioned a bit earlier, those can be either periodic or paid at maturity and will freeze along with their corresponding principal. And just as an additional caveat, even though that coupon has already been accrued, you know you're receiving it, it doesn't accrue any interest during the period during which it's frozen while the kind of redemption for the principal is determined, which can be a sizable amount of time. Credit events and event determination dates. So credit events I'll speak more about in a moment, but will largely follow the same terms and definitions as you see in CDS. So failure to pay, borrowed money, etc. And the event determination date is really where you have the timing of both the underlying credit event, the ISDA determinations, and the note really all come together. So unlike in a CDS, because of the note structure, we are locked into the idea that the calculation agent is the one who's going to make all determinations with respect to the note. And that calculation agent determination, even if it's just a pass through of an ISDA committee determination or something else that's kind of very definitive and easily identifiable in the market, there still has to be a provision for that to be made by the calculation agent and then passed through as a trigger on the notes. And so you'll have the event determination date, which is when that credit event is deemed to occur. Then we have conditions to settlement. So this is really, bringing that operational timeline to conclusion. So, once the credit event has occurred, then there needs to be the operational concerns of, whether or not we're waiting for the auction or time to determine the value of any of the underlying obligations. Or in the case of physical delivery, the issuer needs to acquire obligations in order to deliver them. The conditions to settlement will set out all of these concerns. We'll address all of these concerns as what will happen before the settlement date will actually be set and go forward. And then for settlement method, so just like any other sort of structured note, they're both cash settled and physical varieties. You can also have auction settlement, meaning you'll just pass through that is the auction determination price. So obviously, a twist on a cash settlement. So on the next slide, I go back a little bit to the obligations. As I mentioned, there's a lot of layers here. It's definitely a bit of an onion. So starting with, all obligations of the reference entity, anything up to and including a handwritten IOU. Obviously, we don't care about all of those. If we can go to the next slide. We can see that the obligations that we really are concerned about, it'll follow the CDS format that many of you are used to seeing. So it'll be an obligation category. So that can be payment, borrowed money, loans, bonds, etc., as well as characteristics. So generally you're talking about seniority there, but there can be a few additional categories which have been noted in the materials. And then from obligations, we'll get into deliverable obligations, which are obligations that you may actually receive in terms of your note. And just before we move to that next slide, though, I do want to be clear that obligations can also include obligations where the reference entity is the guarantor rather than the principal obligor on the note. And we most commonly see borrowed money as the CDS category here. So then moving to the next slide, we're then talking about deliverable obligations. So this is a subset of the obligations. So any sort of default on any of the obligations could lead to a credit event on your note. but deliverable obligations are only the obligations that you may receive as payment on your note, or the value of the obligations that will determine your payment on the note, depending on the type of settlement. And again, this can be either a direct obligation or something that has been guaranteed by the reference entity, and you'll again see the pass-through of those CDS categories. Then kind of further narrowing this down, we have the reference obligation, which is on the next slide. So when we use the term reference obligation, though it can be used more generally, it's usually when a very specific obligation is used to determine the kind of the specific bond or loan, et cetera, that the note will be tied to. This has the advantage of making sure that that category of obligations and deliverable obligations is known at the outset to include at least this item, as well as just kind of clarity generally about what you might receive. That said, anytime a reference obligation is specified, usually there'll be a provision where you lay out the terms where that reference obligation can have a substitute from the pool of deliverable obligations or obligations should something occur with respect to that specified reference obligation. And that's also the case with deliverable obligations, that there'll be some sort of provision to allow the broader obligations category to fill in where necessary, including where there may not be enough deliverable obligations available to fulfill the settlement on the full notional of the CLNs. And what we definitely do see is a standardization of reference obligations. So, for example, with these kind of CLN indices, usually produced by market, you'll see standardized ISINs that will be used for many reference obligations for CLNs. Okay. Moving on to the next slide.
Just before, just going to add one observation, Marla, just to that. And so essentially what we're doing, because we've got that sort of onion, what we're essentially saying is that something bad must be happening to trigger a credit event. So as Marla said, you're not going to trigger just on your company's obligation to pay its electricity bill or whatever. It has to be generally borrowed money obligations, or sometimes just bonds or loans. And so we've established something bad has happened. The reason why we have a narrower subset for deliverable obligations or valuation obligations is principally because when there has been a credit event, what we're trying to do is establish what the recovery rate is for that particular reference entity on debt of that reference entity. And so what we're trying to exclude by using these deliverable obligation category and characteristics is any kind of extraneous factors which might affect the value of that obligation beyond the simple perceived recovery in the insolvency or in the distress of that underlying reference entity. So that's why we sort of exclude things like obligations that are not transferable, or obligations that are denominated in local currency for emerging market issuers, and so on and so on. And then, as Marla said, that reference obligation in the vanilla CLNs gives us essentially a benchmark on which to determine the other deliverable obligations, in particular to determine whether we're looking at the senior debt or the subordinated debt of the issuer. So you may trade both senior debts, CLNs and CDS, and the subordinated debt, CLNs, CDS. And that's determined whether we choose a reference obligation, which is a senior reference obligation, or a subordinated obligation. And then in those bespoke CLNs, we very much use that reference obligation concept to say, this is the particular obligation we're looking to hedge. And if you buy this credit-linked note, this is the obligation you are getting exposure to. So whatever the recovery is on this, or whatever happens with this, you may end up being either delivered this particular obligation, or we're going to be valuing this obligation in order to determine what your payout is in the event of credit event. Sorry, Mark, thanks.
Oh no, thank you for adding that in. I get a little too into the details sometimes, so it's good to have the bigger picture. And I think on the next slide we've reached our first CLN code, which is 13CLN10. That's 13CLN10. And then moving on to the next slide. So here we see the credit events. So anyone who's used to working in the CDS space, you'll notice a lot of these are familiar. They're pulled directly from the definitions. Similar to the reference obligations, you will see some customization here, especially with respect to the bespoke CLNs. So for example, in a bespoke CLN where you've created a custom reference obligation that corresponds to a note where perhaps the issuer is one of the parties and could determine an event of default, or where it's not able to determine an event of default in its sole discretion, but wants to exclude certain defaults that could be later remedied. That would all come into failure to pay, where you would very much match those terms to the underlying agreement and what you wanted to achieve. But yes, I think all of these are, other than that, generally come almost wholesale from the definitions, as you would expect them to. And then moving on to the next slide, as I mentioned earlier, one of the things that also comes into this a lot is making sure to include, when choosing a reference entity, thought about what the successor entity would be and what qualifications an entity needs to meet in order to be considered the successor entity for purposes of the notes. And this is generally determined by the subset of obligations for bonds and loans. And you can have sole successors, multiple successors, generally depending on the mix of where those obligations end up. I think our next slide, we begin to talk a little bit about the different structures that the CLNs can take, depending on how they're issued. So for bank programs, which I'll address, and I think Chris will speak a little bit more to SPV programs. For the bank programs, just like any sort of MTN issuance, you would use the proceeds for general corporate purposes. They're not in any way segregated off. And the investor would have full recourse. So, a lot of times, and we'll talk about this when we discuss the documentation, CLNs in the US are done off of the existing structured note or MTN programs, and both your use of proceeds and your investor recourse is going to be exactly the same as it is for any other issuance under those programs. Similarly, the bank is fully within its own discretion on how and if to hedge. Obviously, in certain situations, the obligations that would be the hedge are already held by the bank, and the CLN is itself the hedge. And there's no connection between the bank between the bank's investors and the bank's hedge. So your hedge doesn't need to be disclosed, which can be particularly important depending on the obligations underlying the bespoke CLNs, because sometimes there are confidentiality clauses there that also need to be considered. And with that, I think, unless there are any questions or anything I haven't touched on, I'll hand it back over to Chris for a description of SPV issuances.
Thanks, Marla. Yeah. So just looking at the diagram on the right here, so we see a very similar structure between the relationship between the investors and the issuer here. But instead of the cash proceeds of the issuance of the note going directly to the bank to use for its own purposes, what would typically happen in this SPV structure is that those proceeds are then used to purchase collateral to collateralize the obligations of the issuer under the CLN, and then the SPV issuer will itself enter into a relatively standardized CDS contract with the bank. And so not only will that collateral support the SPV issuer's obligations to its investors, it will also support the obligations of the issuer to the bank. And more specifically, if there is a credit event under that CDS, then the settlement payment that is required to be made by the SPV to the bank will come out of that collateral, and the investors will get whatever is left. So the investors should be looking to get the same, essentially the same outcome as they would if they were just buying paper issued by the bank. They do, of course, take the risk of the collateral, but the collateral typically would be a very high rated paper, could be government bonds or paper issued by a very highly rated corporate, and that can then essentially make the sort of isolate the credit risk of the bank CDS counterparty and potentially get a better credit rating on the notes than you would do if it was just issued by paper was just issued by the bank. Of course, here the investors have no direct recourse to the bank here. They're relying on the structure working as it's described to them, and that means that there'll typically be security granted over the collateral and the accounts that the collateral is held in. There'll be a trust instrument or an indenture for governing the relationship between the issuer and a trustee or an agent on behalf of the investors, and then there'll be various other agency functions as you typically see in an SPV program, like a paying agent and a collateral agent, calculation agent, etc. So it's a more complex structure. There are SPV programs, certainly in Europe and Asia. We work with SPV programs that banks have established. The issuances tend to be somewhat more complex. There are often additional sort of what I describe as bells and whistles. So it may be that you have you're getting exposure to multiple CDSs. You may have a situation where you have one CDS with the bank is long exposure and one is short exposure. So there's a sort of a structure which allows some ability for the investors to achieve a greater return than they would otherwise. We've seen structures which denominate in different currencies, so you have an embedded currency swap. Sometimes there's a basis rate swap as well. So lots of different potential with those kinds of structures. As I say, much more bespoke. You tend to see fewer of these kinds of structures used for those sort of bespoke CLNs that are only looking to cover the risk of a particular obligation, because typically that obligation would not be moved to an SPV issuer to issue in a way that perhaps it would in a CLO. But it is occasionally used for that purpose as well. So just moving on to the next slide, just a couple of minutes. We've touched on some of this already in the presentation, but this is the differences between single name basket and index CLNs. Very much as the name suggests, single name CLN is like the instrument that the Cardinal bought. We've got one single reference entity, could be a corporate, could be a sovereign, and upon a credit event with respect to that reference entity, so that reference entity files for Chapter 11, like Hertz did, the CLN would be either cash settled by payment established in instant auction, or otherwise established by a dealer valuation process, or physically settled. So physical settlement, as we'll look at in a little more detail, it essentially involves delivering obligations of that defaulted reference entity in full settlement of the note. Normally, the settlement of all these CLNs happens at the time that the credit event occurs, but occasionally there'll be a settlement at the scheduled maturity, reflecting the fact that the credit event has occurred. If basket CLN or a portfolio CLN, used somewhat interchangeably, is effectively you've got multiple reference entities that the investor is taking exposure to, and there's broadly two ways in which that exposure can be taken: either apportioned equally or in some predefined proportion between the various reference entities, which is, as Marla said earlier, essentially like buying, instead of buying one single name CLN, it's like buying 5 single name CLNs if you've got a basket of 5, and each of your total risk, your principal amount, the risk is allocated between those 5 CLNs. So you've got a $10 million CLN, then 2 million may be at risk for one entity, 2 million for each of the others. So there's a credit event, you settle that one entity, and then the remainder of your principal would be safe until another credit event had happened with respect to one of the others. The alternative method of basket portfolios, you have this concept of a first of default, which is a higher risk instrument, because that essentially multiplies the risk. So your exposure is to each of the reference entities. But if one of those reference entities suffers a credit event, then the entire principal amount is at risk because of that credit event, and they then redeem as if that had been a single name CLN. Finally, you have index CLNs, which are just really a subset of portfolio CLNs, except the index is a basket or portfolio of names which is established at the outset of the trade and published by an index administrator. So, as Marla mentioned, IHS Markit published the iTrax and CDX families of credit indices, and they are essentially portfolios of reference entities with similar characteristics based on jurisdiction or the credit worthiness of the entity, or whether it's a sovereign or a corporate. So there's probably around, I don't know how many last counts, on 15 to 20 different families of indices. Some look at sovereign credit, some look at corporate, some look at North America, Europe, Asia, etc. And so you can, as an investor, choose which exposure you want, and then get an exposure to a broad portfolio to essentially dilute your risk to one specific reference entity and give you effectively a synthetic exposure to all, or at least a cross section of the credit in that particular jurisdiction or in that particular senior or subordinated or high yield or investment grade entities. And that takes us on neatly to whether to tranching, which I think is our next slide, hopefully. And so these index CLNs can either be untranched or tranched. And effectively what untranched means is that it's very much like I described on those basket CLNs earlier, where effectively it's like buying, you have an index of 100 names, like buying 100 different CLNs, each worth 100th of the principal amount that you're investing. So in this example on the left, we have here a $10 million portfolio. So if you bought $10 million of CLNs, effectively your exposure to each of the 100 reference entities in that index would be $100,000. So each time a credit event occurs, you effectively settle 1% of the entire CLN and essentially make a payment based on the recovery price of that particular reference entity. So if we had bought that note today and tomorrow there's a credit event with respect to the first reference entity, then $100,000 of our principal would be at risk. We would determine what the recovery price is, either through the ISDA auction or by the relevant method specified. And if we determine that that recovery price is 40 cents in the dollar, then you as an investor will get your for $40,000 there principal back, but you essentially your note will be written down by the entire $100,000, and that's how an untranched CLN works. On the other hand, so a tranched CLN, again, you have a portfolio of 100 names in this example, but instead of taking equal exposure to each of the names and having it trade like 100 separate CLNs, what you do here is every time that there is a credit event, you count up the losses for that particular reference entity based on what the recovery price is, the final price is for that reference entity, and then you aggregate those losses together. So each time there's a credit event, you add that to the the aggregate loss amount. And once those losses hit a certain threshold, we call it the attachment point of where your tranche is, then you start losing money on your credit linked notes. So in this example, we have a tranche that is the 10 to 20% portion of the entire portfolio. The portfolio here is a larger portfolio, so it's effectively $100 million of portfolio. Again, it's a $10 million CLN, but we're only taking exposure to that 10 to 20% tranche. So each time there is a credit event, we'll work out what the loss is from that credit event. That will get added to our aggregate losses. And then when our aggregate losses exceed, in this case, $10 million, then every other subsequent credit event, the losses will count against our tranche. So these were quite common, these sort of tranche products prior to the financial crisis, 2008, 2009. But although you need to suffer a certain number of losses in here before you actually get the tranche, unlike the untranched product where you effectively lose money on your first default, your first credit event. Here you are at greater risk if there is a sort of concentration of credit events to your principal amount being eroded very quickly, because it only can take, in this case, 20 credit events to have happened to erode your entire principal amount. Typically, the tranches may well be lower than that. You maybe sort of see 3 to 5% or 3 to 7% tranches. So depending where your tranche is, you may lose your entire principal sooner. Whereas in the untranched CLN, you're only ever going to lose your entire investment if all 100 of the names have suffered a credit event, and the loss on those names has been 100% each. So that's a brief comparison of tranched and untranched CLNs. We talked a bit about it already, but just the next slide just looks at those settlement methods. I don't know, Marla, if you just want to say a couple of words about that.
Sure. And we've basically listed them in order of ease. So auction settlement means you're directly passing through the ISTA determination, which is given as a ratio. So you just multiply by your par amount, and then settle in cash for that amount. The fallback for auction settlement, or you can select in its own right, is cash settlement, which is just the calculation agent determining the value of the relevant obligations. Normally this is done by dealer pool, and you'll specify how many dealer quotes that you'll need to receive. The third form of settlement, and this is largely seen in the bespoke world because you have a very specific reference obligation, is physical settlement, where you'll just deliver an amount of the relevant obligations equal to the principal amount, or with the same notional amount. That said, there are some challenges with physical settlement, especially if you don't have enough of the relevant obligations on hand to deliver. And physical settlement will also have the fallback of auction or cash settlement, usually cash settlement. Moving to the next slide. Sorry if I've started speaking quickly. I just noticed we're low on time, and I don't want to run into anyone's next call. Chris, do you want to speak a bit about basis risk?
Yeah, I'll just do a couple of minutes on this. So I said earlier, one of the things we're most concerned about is the basis risk between the CLN and the underlying. And there are some sort of areas that come up repeatedly when we're looking at this, both in terms of the vanilla CLNs that are repackaging credit default swaps and those bespoke risks that are being packaged into CLNs. On the CDS side, two of the sort of the most thorny issues are, one is the timing of credit events. And this arises because under a bilateral CDS contract, then there's the ability for the termination date of the transaction to effectively be extended to wait for a determination that there has been a credit event within the relevant protection period. So if you have a year-long protection period and there's a credit event occurs on the last day of that, then it's not going to be for some time after that you're actually settling that event. Whereas if you have a credit linked note, like most structured notes or most vanilla notes, you have a maturity date, and you're expected to redeem the note on that maturity date. So the kinds of issues that can come up is that under a standard CDS, you're given 14 days notice delivery period. So if there has been a credit event on that last day, you have another 14 days to deliver a credit event notice under your CDS. So of course, if you're hedging with CDS and your note runs to the same maturity as your CDS contract, then there's a risk that you miss that credit event, repay your investor and walk away with their money, and then you're on the hook for paying out on your CDS. Similarly, that happens with potential failures to pay can happen at the end of transaction. There's been a failure to pay with a grace period hasn't run yet. And of course, the determinations committees that decide whether there's been a credit event for most names these days can take some time to deliberate, sometimes a number of weeks to deliberate. So it's important in the terms of your CLN, if you are hedging the CDS, that you build in a buffer to allow for these kinds of events. And that can either be done by essentially having a maturity of your CLN that extends some way out beyond your CDS contract to allow you time to allow for those eventualities, or have a mechanism in your CLN that allows you to suspend redemption on the occurrence of certain events, whether there's potential failure to pay, whether there is a suspected credit event, whether a question is raised to the determinations committee, and so on and so on. So it's important to bear that in mind in terms of managing your basis risk. Another area which has been quite notable recently is also, as with other derivatives products, the CDS market has a habit of having various patches and fixes put in periodically by means of protocols. We saw that when the 2014 credit derivatives definitions came in, and more recently with the narrowly tailored credit event protocol. Now, these protocols are widely adopted by the market and then obviously update the terms of all credit default swaps between adhering parties, but they don't capture the CLNs. So what you want to do is build in a mechanism in your CLN to provide for the terms to be amended in accordance with those protocols as well. Otherwise, you're inviting a basis risk to emerge in the future between the terms of your CLN and your CDS. Next slide, just a couple of other problems that arise in the context of these more bespoke CLNs, and that really it sort of comes down to the nature of the underlying. So if I'm issuing a CLN that is trying to hedge my risk under a loan that I've extended to, it might be an emerging market government, or it might be a large corporation, I may be under confidentiality requirements, so there may be a default under that loan. But that hasn't been publicized. It's not like a sort of Chapter 11 filing, which is public to everyone, but I want to realize my protection at that point. So there may be problems with information flow between the underlying and the credit link note. So how do you solve those? Well, if you're able to at the outset, you might want to put provisions in your underlying loan which allow you to disclose in those kinds of circumstances. Or if you haven't, you may then in negotiation with your CLN investor to say, well, you have to trust us when you tell you there's a credit event, or you have to sign some kind of NDA for us to tell you, or we have some kind of third-party verification agent, or indeed, if your investor doesn't agree to any of those, that you just have to wait until the actual event becomes public, or you have to file a bankruptcy proceedings yourself in order to get that default publicized so you can settle your credit link note. Again, similar other issues around sort of the valuation and potential defenses that you may have under that underlying loan because of the sort of bilateral nature of the fact that you've originated that loan. And those are kind of risk allocation problems that we have to grapple with in the context of credit link notes. So that's all I was going to say about that. Just the next slide just shows one other sort of just graphical illustration, really, of some of the areas of basis risk that can arise. And this is a slide that I put out in sort of CDS presentations just to show actually the complexity of CDS contracts, even though they look relatively standardized and simple these days. There's an awful lot of information and documentation under the water. So it's really impossible to legislate for every kind of eventuality that's going to happen. So it is very important just to when you're drafting a CLN, to be mindful of all the potential things that can influence your underlying CDS contract. Marla, do you just want to I think we're just 1 minute over time, so if you could perhaps just do 1 or 2 minutes on the documentation and the rest of the considerations.
Sure, I'll be as efficient as possible. So the US documentation structure is very similar to any other structured note, where we'll use the existing MTN program or structured note program. You can use a CLN product supplement. When used, these, very similar to the ones in Europe, will just almost wholesale include the CDS definitions with kind of an on-off switch type provision. We normally don't recommend that just because of the nature of kind of the issuance activity we see in the US. So normally what you'll see is just one standalone pricing supplement on top of that MTN documentation. And that pricing supplement will contain all of the relevant definitions, but only the relevant definitions. And it will also include a lot of bespoke risk factors based solely on the reference entity and the settlement provisions that you've included. And often, because of the investors involved, these will also go straight to black. Then next slide. So some of the US specific considerations that we often see are investor suitability. So unlike in Europe, there is no retail market for CLNs in the US. It's really just sophisticated investors. And depending on the particular investor, we would recommend investor representation letters, particularly if it's not a QIB, if it's an accredited investor, say. And then the other thing that comes up a lot while we're doing these transactions is credit ratings. So the majority of CLNs aren't rated, but in certain instances, certain types of investors have requested it. This process does take a little bit more time than most are used to with other issuance types. The rating agencies, do take a bit of time just to get their handle on the documentation, and they usually won't start their review until they have a full set of draft documents. So there's a lot of extra turnaround time involved, and we've had a lot of calls explaining, especially in the case of bespoke CLNs. And the other question that always comes up with the ratings is whether 17G5 is applicable. And it's actually not applicable to CLNs because there's no segregated asset pool. And just to close this out, for tax considerations, it will depend on the specific circumstances of the note. So talking with our tax team is always a part of these to determine whether or not they'll qualify for debt treatment. Sorry, that was the last 2 slides in 30 seconds or less, but if anyone has any questions, please feel free to do so now. So I hand it over. Are there any questions, or Chris, any final thoughts from you?
Nothing further from me. Thank you everyone for it. Apologies for going a couple of minutes over time. There was a question on the chat as to whether we will be circulating the slides, and we will do so to all of the attendees after the call. So there's quite a lot of information in there, most of which we covered, but hopefully that will be a bit of a refresher for you all. And of course, Marla and my own details are on the slide, so please do feel free to reach out to us directly if you do have any questions on the presentation or generally in relation to CLNs. But thank you very much indeed for your time.
Thanks, everyone.